Hello viewers, welcome to another exciting edition and thanks for watching. If you are new here, welcome. Be sure to subscribe and turn on notifications so you don't miss any of our videos. Let's start our today's topic. Our today's topic is loan. Working capital loan definition. What is a working capital loan? A working capital loan is a loan that is taken to finance a company's everyday operations. These loans are not used to buy long-term assets or investments and are instead used to provide the working capital that covers a company's short-term operational needs. Those needs can include costs such as payroll, rent, and debt payments. In this way, working capital loans are simply corporate debt borrowings that are used by a company to finance its daily operations. Key takeaways. A working capital loan is a loan taken to finance a company's everyday operations. Second one option that I discussed is working capital loans are not used to buy long-term assets or investments. They are used to provide working capital to cover a company's short-term operational needs. Third one is companies with high seasonality or cyclical sales may rarely own working capital loans to help with periods of reduced business activity. Fourth one is active working capital loans are often tied to a business owner's personal credit, so missed payments or defaults may hurt their credit score. Understanding working capital loans. Let's now understand working capital loans. Sometimes a company does not have adequate cash on hand or asset liquidity to cover day-to-day operational expenses and thus will secure a loan for this purpose. Companies with high seasonality or cyclical sales may rely on working capital loans to help with periods of reduced business activity. Next one, many companies do not have stable or predictable revenue throughout the year. Manufacturing companies, for example, may have cyclical sales that corresponds with the needs of retailers. Most retailers sell more products during the fourth quarter, that is during the holiday season, than at any other time of the year. To supply retailers with the proper amount of goods, manufacturers typically conduct most of their production activity during the summer months. Readying inventories for the fourth quarter push. Then, when the end of the year hits, retailers reduce manufacturing purchases as they focus on selling through their inventory, which subsequently reduces manufacturing scale. Manufacturers with this type of seasonality often require a working capital loan to pay wages and other operating expenses during the quiet period of the fourth quarter. The loan is usually repaid by the time the company hits its busy season and no longer needs the finance. What is the important point of this discussion? Let's see the important point. Missed payments on a working capital loan may hurt the business owner credit score. The loan is tied to their personal credit. Is it clear? Types of financing includes a term loan. There are three types. Let's see. Term loan. a business line of credit, or invoice financing, a form of short-term borrowing extended by a lender to its business customers based on unpaid invoices. Business credit cards, which allow you to earn rewards, can also provide access to working capital. Pros and cons of working capital loan. There are many pros and there are many cons of working capital loan. Let's see what are the pros and what are the cons of working capital loans. Pros and cons means there are some advantages and there are some disadvantages of capital loans. The immediate benefit of a working capital loan is that it's easy to obtain and lets business owners efficiently cover any gaps in working capital expenditures. The other noticeable benefit is that it is a form of debt financing and does not require an equity transaction, meaning that a business owner maintains full control of their company if it is financing need is dire. Some working capital loans are unsecured. If this is the case, a company is not required to put down any collateral to secure the loan. However, only companies or businesses owners with a high credit rating are eligible for an unsecured loan. Businesses with little to no credit have to securitize the loan. A collateralized working capital loan that meets asset collateral can be a drawback to the loan process. However, there are other potential drawbacks to this type of working capital loan. Interest rates are high in order to compensate the lending institution for risk. Furthermore, working capital loans are often tied to a business owner personal credit, and any missed payments or defaults may hurt their credit score. Next, let's see the fundamentals of corporate finance and accounting. Whatever your learning style, understanding corporate finance and accounting is easy when you can choose from online video courses. With Udemy, you will be able to learn accounting terminology and how to prepare financial statements and analyze business transactions. What's more, each course has new editions published every month and comes with a 30-day money-back guarantee. These are some terms about the working capital loan definition. Let's again review the key words of learning capital loan. First one that I discussed is a working capital loan is a loan taken to finance companies' everyday operations. This is the first one key point. Second one key point is working capital loans are not used to buy long-term assets or investments. They are used to provide working capital to cover a company's short-term operational needs. Is it clear? Next, third one point is companies with high seasonality or cyclical sales may rely on working capital loans to help with periods of reduced business activity. Fourth one point is working capital loans are often tied to a business owner's personal credit, so missed payments or defaults may hurt their credit score. These are all about the loan. If you have any more question, just comment below the comment section and we'll try to answer your questions. Thanks for watching.